It's time to define a marketing term. Commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub, joins us. She believes, of course, the key to profitable grain trading is building knowledge about the fundamental practices of the industry. Today, she'll help us discuss just exactly what it is that defines the two words, fungibility and liquidity. But we'll start off in kind of a different area, but it's related to these, and talk about the trouble with cash contracts. As you see it, Elaine, what are the fundamentals behind this, and what makes up a cash contract, and how do you develop it on a modern futures exchange, those sorts of things?
Well, Todd, we kind of touched on this last week when we talked about counterparty risk. The idea that you might write a forward cash contract with some grain buyer, but have the risk of maybe that grain buyer going bankrupt and not being able to honor their check to you. Or on the other hand, you have cash grain buyers who, what if the farmer does not bring in the grain that they committed to sell? So that's one of the problems, if there are problems, if you think about problems with cash grain contracts, that's really it, is this idea that you're really dealing with very specific samples of actual physical commodities, and those things may not move around like you expect them to, or may not have the quality that you expect them to. They're really not standard.
Right, and so once we get into the counterparty risk, there's both at-fault and no-fault risk?
There can be. I mean, there are certainly situations, let's say there's a drought. This is a really good, timely situation, and a farmer committed to sell some grain to a buyer, but just literally does not have that grain to sell. In that instance, he didn't commit a fraud, he didn't do something wrong, and yet nonetheless, the buyer was counting on that in their position for their accounting. So the cash still needs to come from somewhere, the money still needs to come from somewhere. And in that case, you have to buy out of your cash grain contract, and that's not always an easy thing to do because there's no standard way. There's no really good centralized place that you can go to find a new price for that new cash contract that you have to buy out of.
So now let's define a couple of other related terms, fungibility and liquidity. And these deal with, well, liquidity, of course, with the futures market, but fungibility comes in where?
Fungibility is directly tied to this idea of these cash grain contracts. That let's say you want to get out of a cash grain contract you already made. A fungible asset is one that you could easily convert to cash, or that there is a known price. It's interchangeable with other assets, or specifically cash. So a cash grain contract is not particularly fungible because there's not always an opportunity to turn that into cash. The buyer that you want to the counterparty that you want to get out of that with may not be willing to do so, or may make it difficult or put up barriers for you to do so. So in that sense, cash grain contracts are not very fungible. Whereas futures contracts, where there's always an entire universe of people that are always willing to exchange a cash or a futures contract for actual money, for cash in your brokerage account, that's a very fungible asset.
If you've done that, you're into a liquid market at that point.
So now you're in a liquid market, but futures markets can be more or less liquid on any given day. Liquidity comes into how easily you can change that thing into cash and how that affects the price. So in an illiquid futures market, you may change your futures contract into cash that day, but by doing so, there's not a lot of other volume going on in the market. There's not a lot of other people participating. So the price impact of you doing that, it can become very large in an illiquid market.
Yeah, so the goal of an exchange is to have a liquid market for a futures. How does it make it smooth and liquid and set a standard price for grain?
Well, it has market makers, and it certainly tries to encourage a lot of participation from a lot of different, people. You get the commercial traders that are in there hedging. They also try to encourage speculators. They make an environment that is conducive to speculating. Even the high-frequency trading, the exchanges love that, obviously because they're making money from all of the trades that are happening, but also because it adds liquidity. It adds more volume and more price points for people to participate in and keep a liquid price movement going on.
Thank you so much, Elaine.
Thanks, Todd.
That's commodity broker, analyst, and author of Mastering the Grain Markets, Elaine Kub. For University of Illinois Extension, I'm Todd Gleason.